guys, I'm going to be going over chapter 11 for business finance, which is all about risk and return in capital markets. This all relates back to our EOS project on chapter 8, which was all about investment decisions, because risk and return is all about if the decision was worth it in hindsight. First, we looked at historical risk and returns of stock, and some important key terms to know were that T to T plus 1 is the realized return from investing in a stock, and R to the T plus 1 equals the digit in year plus the capital gain yields. Some important takeaway from that is based on historical data, small stocks has held higher volatility and higher average returns than larger stocks, as well as the fact that about 95% of possible outcomes lie within 2 standard deviations above or below the average outcome. This one hand with the historical trade-off between risk and return was more of a philosophy part of the chapter than math, as we learned that there is no clear relationship between volatility or standard deviation and the return of individual stocks, but larger stocks tend to have low overall key standard deviation and are typically more risky individually than in a portfolio. A few more important key terms to take away from this chapter were common risk, which is risk that is perfectly linked across investments, versus independent risk, which are unrelated across investments, and diversification, which is the averaging of risk in a large portfolio. Diversification is important because the total risk diversity both on systematic risk and unsystematic risk. Diversification eliminates unsystematic risk, which is variation in a stock's return due to industry-specific or firm's news.